Hey, what's up, my friend? So today we have Adrian Reid on the show, baby. So Adrian is a systematic trader who trades both stocks and cryptocurrencies. And what's interesting about Adrian is that he wasn't always a systematic trader. In fact, he started off with fundamental analysis, then he moved on to technical analysis, being a discretionary trader before finding success as a systematic trader. So today he trades multiple trading systems across different markets like US, Hong Kong, Australia, etc. And he has trading systems that both goes long and short. In other words, he can make money when the market goes up or goes down, yeah? So if you want to connect with Adrian, I'll put his social media profile in the description below. Now, moving on in today's conversation, right, you'll discover firstly how Adrian got started in trading, and it's really a very unique story and hopefully something that I can inspire my kids, to take up as well, right? Then we talk about the struggles he faced as a discretionary trader and how he finds success in systematic trading. We also spoke about how he developed a trading system for a completely new markets that he has never traded before. He'll share his approach to doing that, and I thought that was really fascinating because those are principles that you can use, right? Especially if you want to dive into new markets that you have not explored before. Then we also spoke about the different type of trading systems that he employs so he can profit in bull and bear markets. And towards the end, he also shared with us, right, a complete mean reversion trading system, right, that works. He talks about the principles behind it, the lessons learned, and how you can actually implement it on your own. So all this and more in today's episode. Sounds good? Then go listen to it right now. All right, so Adrian, welcome to the show.
Thanks so much for having me. I'm super excited about this. I've been looking forward to this for a long time, Rayner.
I'm happy to have you as well, Adrian. And as I shared earlier, right, I actually came across, I got deeper and know you better through the Better Systems Trader podcast, a fantastic podcast, by the way. And I think what really, brought me laughter while listening to the podcast is actually how you got started in trading. So maybe you can just give us a quick backstory, how you got started in trading, because I thought that was a great one.
Yeah, great. Look, way back at the very, very beginning, I was about 8 years old, and we're at my family's holiday house, and we found this game in there which wasn't ours. Someone had left it there. It was called the stock market game. And in that game, you go around the board, and the market moves up and down, and you buy and sell stocks, you collect dividends, and you become a billionaire very, very quickly. And I thought that was the best thing ever. And so if there was a positive introduction to the markets, I definitely had it because that was amazing. Of course, it was a while before I actually got started trading for real. And when I finished university, graduated and got my first job, I discovered what the workforce was like. And I quickly realized that I didn't want to do that forever. And so I talked to the adults that I knew. I talked to my father and I said, "Hey, Dad, I really don't want to work forever. What do I have to do so I can, retire early?" And of course, he laughed at me. I'm like 20 something, and he's been working for how long? And then he said, "Well, look, if you want to retire early and don't have to work your whole life, you got to learn to invest." And so we talked about investing, property, shares, other investments, and I didn't have the money for property. So I got interested in the stock market, and I started researching, started buying stocks that I knew, companies that I thought were good companies with good products, companies that people recommended. And of course, none of that worked. And then I tried fundamental analysis. I looked at balance sheets, and I looked at profit and loss and earnings statements and dividends. And of course, that didn't work. And so I tried lots of different things. And then I came across technical analysis, and I studied engineering, right? So the charts, the mathematics of it, the trend lines, all of that just appealed to me. I thought that was the best thing ever. So I started drawing lines on charts and indicators and had squiggly lines all over the place. And of course, that didn't work either. But I really loved it. And so I was spending 4 or 5 hours every single night running scans, drawing trend lines, support and resistance, looking at indicators for confirmation, blah, 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 all the stuff. And, I just wasn't getting anywhere. And I was so frustrated because I knew there was something there. I knew money could be made, but I just wasn't making any. I wasn't losing much. I was very conservative. I had good position sizing, good risk management right from the beginning. But I just wasn't making any money. And, I was sort of at the verge of quitting. And instead of quitting, I decided I'd double down, and I started ordering books from Amazon, and I'd get boxes and boxes of books. I was reading all sorts of things. And I came across Market Wizards, which is still on my shelf over here. I read all of the Market Wizards books. And that was amazing, right? Because I read the interviews in Market Wizards. It's like, oh, that person, they've got a horrible life. I would never trade like that. Like, screens in the bathroom, screens in the bedroom, wake up every 15 minutes at night to see what was going on. Forget that. And then there was another person that was like doing deep, deep fundamental research. I was like, oh, I could never do that. It's so boring. And so I basically crossed out all of these interviews, and I found the ones that really appealed. And this is where the magic happened, is where I sort of turned the corner, because the ones that really appealed were the systematic traders, like the turtle trading style, purely objective rules, all back tested. And again, the engineer in me just went, that's it. And so I just doubled down on systematic trading, and I read book after book. I did a few courses, and I just went all in on that. And I launched my first system. I took 3 months off work to build my first system. And once I launched it, account turned around, started making money, and been systematic ever since.
It was a trend-following system. Did I get it right? If I recall?
Yeah, absolutely. First system was a trend-following system. I remember the trade that changed everything. It was a small mining company, MCR. It went from, I don't know, I can't recall, 14 cents, 14 and a half cents something to 42 cents. So it's penny stock. And but that was a huge profit, because I pyramided in a couple of times, and that was a trend trade. And from then on, I was just hooked on systematic trend following. And, I did that for a long, long time, 7 years, in fact, before I changed anything.
And maybe to take a little step back, I was curious. You mentioned the stock market game. I'm very curious. Is that game still around? I think it's something that I could get.
I have it, actually. Yeah, I salvaged it from the family archives. I keep it here. I should have brought it in. I could have shown you, but I don't think you can buy it anymore. It's I think it's delisted.
Okay, so it's probably made by some smaller game production companies and then no longer around. Okay, yeah. I definitely want to look for something similar, right, to get my kids involved, expose them as early as possible, yeah?
Oh, yeah, absolutely. And the kids get it, right? I mean, I started, actually, I was saying to you earlier, we lived in Singapore from 2014 to 2017. Around that time, I started teaching my kids about trading, and my daughter was 5. And so, I showed her charts. I talked about, the long-term moving averages. I talked about stop loss, risk management, position sizing, trends. And it's amazing how much they get, when they don't have all of the junk that school has taught them. She was very young. I think she was in kindergarten or year 1. And when they don't have all of the preconceived ideas and the rules that school kind of beats into them, you teach them trading principles. They're like, oh, yeah. I'd show her a chart, say, oh, no, you don't want to own that stock. That's trending down. So, the kids get it.
Yeah, the school will go along the lines of the efficient market hypothesis. You can't beat the markets, so, and then you kind of just kill whatever hopes of, profiting from the markets from then on.
Exactly, yeah. Absolutely.
So, looking back, you've, when you share your journey, as I've, sent a few emails to you, it's like an older brother going through the same journey as me. I went through some so similar, trying, value investing, checking the fundamentals of the company. It got slower. Oh, it's even cheaper. It's a better buy right now. But guess what? Slow becomes slower. So same process, yeah. So you also spoke about, you tried indicators, trend lines and stuff. So I would like to know, why do you think that didn't work for you and then systematic trading worked for you?
Yeah, I think the big thing about discretionary technical analysis that's hard is the discretionary piece, right? You can have indicators and say, okay, well, this indicator says it's going up. This indicator says it's going up. But that indicator says it's going down. And I think this is a support line, but hang on a minute. No, now I need to redraw it now because it's gone a little lower or maybe it should be maybe it should be a little higher. And this is the trend line. Oh, hang on. No, this is the trend line. Or maybe this should be the trend line. That's the problem. It's not repeatable, and it's very easy in the middle of the chart. It's like, oh yeah, that's a buy. Yeah, that's definitely a buy, right? Oh yeah, I would have sold there. It's like, no, you wouldn't. If you look on the far right-hand edge of the chart, these things are almost impossible to do with consistency. And I survived only because I had good risk management. I had very small risk per trade when I was doing discretionary technical analysis. But as soon as I went systematic, all of a sudden the emotions are gone. There's a consistent process. I can test and evaluate the process. So hang on a minute. That doesn't look like a good trade. And the system says buy. So why doesn't that look like a good trade? Oh, it's because it's too volatile. Let's test a volatility filter and see if that hypothesis is true. And you can get evidence, back-tested data to tell you should or shouldn't kind of trade that sort of stock. So you can really test and evaluate rather than just be blindly driven by your emotions. And, that's what discretionary traders really struggle with, is the inconsistency in the emotion.
Right. And also, because I have done discretionary trading, systematic trading, I've done both sides of it. And I think one of the struggles that many discretionary traders find is that, I know, systematic trading, there's benefits to it, but I can't program, Adrian. I'm not sure how to, write the codes and stuff like that. What would you say to someone who, can't program for nuts and they want to be, let's say, a systematic trader?
Look, I hear that so frequently. And to be honest, my belief is that it's an excuse. And I hate to sound harsh, but I couldn't program when I started either. But I had the desire to learn because I knew that I wanted to be systematic so that I could eliminate the emotions. I could be consistent. I could test my ideas. I could prove that I had an edge. And if you want to do all of those things, and if you could do all of those things and that could make you hundreds of thousands or millions of dollars, wouldn't it be worth learning something new? Right? And, I found actually that it's not that hard if you're a somewhat analytical person to learn to code a strategy. And the good thing is, if you're not a coder, I'm not a coder. I didn't do computer science. I didn't study any coding in school, anything like that. So if you're not a coder, the tendency is to keep things simple. And that works. If you are a coder, the tendency is to make it, really complicated and rocket science and trying to all of the formulas and rules and, loops and fancy programming. And that doesn't work, or at least not in most cases. So people who aren't coders, I would say don't let that hold you back. Have the vision of being a systematic trader so that you can have consistency, so that you can prove you've got an edge, so that you can test your hypotheses and know for sure one way or the other, is it a good idea or is it not? And use that as the drive to learn the skill. Yeah. Because once you do, it's just so powerful.
Yeah. So maybe for those who are still watching, so for me, the path that I took is that I think maybe I had a little bit of entrepreneurship background. So I hired a developer, a coder, right, to help me do the testing. And these days, there's so many marketplaces. Some of them are not really expensive, especially get it from developing countries like Indonesia, Vietnam, or Philippines, right? Pretty decent price and pretty decent work. So again, options for other non-systematic traders to consider if they want to step foot into systematic trading. Yeah. And maybe let's talk a little bit about the stock markets, right? I understand that you offer a number of trading systems that covers different markets. If I'm not wrong, it's Canada, the US, Australia. So I'd like to hear, right, what are some concepts that work in, let's say, in the US stock market, but maybe not so much in other markets? Or maybe we kick things off first, what are some proven concepts that work for the US stock markets?
Well, look, I sort of stepping back, I think about systems, trading systems or strategies in a couple of different buckets, right? We've got trend following, we've got mean reversion, we have rotational momentum, which is somewhat similar to trend following, but a little bit different. We've got seasonality, right? And then there's some other strategies as well. So there's definitely trend following strategies that work. There's rotational momentum strategies that work. Mean reversion can work, but there's been some shifts in the US market over time, and so some strategies that worked, say, 10 years ago don't work now. So market behaviors can shift. And then there's definitely some seasonal patterns in the US market that work. Yeah, the Santa Claus rally, for example. There's the Ultimo effect, which is at different times of the month, the market tends to be strong or tends to be weak. So those are tradable as well. So I would say in most markets, you can find strategies that are either trend following, mean reversion, rotational momentum, or seasonality that work. But what works specifically in the US versus what works specifically in Australia or Hong Kong may be different because the markets have different personalities. Yeah. So in the US, I've got a trend following system. I've got a rotational system. I've got a short side system. I'm not trading mean. Oh yes, I am trading mean reversion system in the US right now. And I've got a seasonality system. So I have the whole set in the US. And I think that's really powerful because that diversification is what smooths your returns, is what means if there's not a really great trending period, something else might be making money. Yeah. The interesting thing, and one lesson that I struggled with at the beginning when I was learning is I was ordering all of these books I was talking to you about earlier, and all of the authors, or almost all of them, inevitably were American. And so I get these books, and I'd look at the strategy, and I was only trading Australian stocks, and I'd try the strategy, and it wouldn't work. It's like, but this is a famous trader. Why doesn't it work? I hadn't realized that different markets had slightly different personalities because they've got, different participants, different exchange rules, different levels of liquidity, different size of companies. And so I think the big learning is that, the generic strategies can work in most markets, but they need to be adapted because the markets are a little bit different.
Could you maybe give an example of the concepts working, let's say, between the Australian and the US market, but maybe the strategy has to be tweaked? Let's say something that works for the US has to be tweaked to cater to the Australian market, maybe something along those lines.
Good one. Good question. So look, a trend following system is a good example. I mean, in Australia, trend following on small cap stocks works really well, long-term trend following. So buying a long-term breakout, holding for a long uptrend with a wide trailing stop. And if you have a system like that filters for low volatility stocks and has a portfolio of, say, 20 different positions managed by the same system, that will work very well over the long run in Australia. That same system translated directly to the US doesn't work so well. Like just a pure breakout, I've found on the US stocks doesn't work as well. So like, let's say in Australia, if the closing price is the highest close in the last 200 days, 200-day highest high, that breakout entry works pretty well for trend following in Australia. On its own in the US, it doesn't work so well. So I found instead that like a volatility breakout where the stock jumps a certain amount within a short space of time, that works well because there were a lot of false breakouts on just the 200-day highest high, for example, in US stocks. So the general concept of these two strategies is very similar, but just the precise trigger, one might be a little bit different from one market to the next.
Oh, got it. Understand. And I think also like, for example, like based on my own testing, like mean reversion trading in the US stock market, I think like, 5, 10, 20-day low, it's possible to make money in mean reversion trading. But if you kind of like do a little bit deeper, like the 50 or 100-day, it kind of stops working. So yes. I won't be surprised if, let's say, the 50, 100-day that doesn't work for the US stock market, it could work for some other stock market around the world. I have no idea which market it could be, but I think that's kind of like expanding on the concept which you shared earlier. The concept works, but I think the parameters or the tactics to execute that concept, that has to be tweaked for the individual countries around the world. Yeah.
Yeah, I mean, we're going to talk about a strategy later on in this conversation, which I'll share the details of. But it's a mean reversion strategy, and that strategy works well on the Canadian market, works okay on the Australian market, used to work well on the US market, but not anymore because the market behavior has changed. And that's an example of like certain behavioral patterns or certain price movements used to be a good signal, but maybe the edge fades over time as too many people are using them. Or maybe the edge fades over time or changes if the market rules change, the participants change. For example, high frequency trading comes in, changes the dynamics of the market. So, strategies that just because it doesn't work in one market doesn't mean it might not be a good strategy in another market as well.
And since you talk about Australian and US so far, how about Hong Kong? Are there any certain distinct patterns in the Hong Kong markets that is different from the rest?
Yeah, I actually really like the Hong Kong market. It's probably, when I added it to my portfolio, I found it a really powerful addition for a couple of reasons. Firstly, diversification. Oftentimes, the Hong Kong market will be strong when the US market is weak or vice versa. a really great side effect of trading the Hong Kong market was it turned around and started dumping during COVID before the US market. So I got short Hong Kong very early in the COVID decline, which was nice. But behaviorally, sort of behavior characteristics, the Hong Kong market tends to be more kind of boom and bust, like more pump and dumpy, if you like. I don't know what the technical term is for that, but I see a lot of stocks rocket up and then kind of fizzle off. Whereas in Australia, for example, I would see there's a lot more instances of very long kind of grinding trends. In the US, probably also more like long grinding moves or step changes between earnings at earnings announcements, that sort of thing. So the behavior is definitely different between the different markets.
And what comes to mind is that since you mentioned that the behavior is different, if Hong Kong is more pump and dump, then I think the trailing stop loss will probably have to be tighter, right? If not, you risk giving back too much compared to, let's say, a market where it's more stair stepping. You can have like maybe a wider trailing stop loss to take into account just something that comes to my mind.
Yeah, I use quite different exits in Hong Kong than I do in the other markets. So there's one that is quite neat where if the stock hasn't made a new high in a certain amount of time, I'll get out. So I'm not necessarily waiting for it to hit a trailing stop. I'm just waiting for it I want it to keep making new highs, but if it hasn't made one for a while, then maybe the move is over and I want to get out before it dumps.
Okay, so you're looking for the momentum, and if momentum starts to show signs of weakness, bam, you're out of there.
Yeah. So there's a lot. I mean, when I'm developing systems, I try and test all of these different styles of rules in each market. I don't want to go into a new market with a preconceived idea about what will work. I want to kind of do the full investigation, understand all of the different types of strategies or types of entries and exits, and how do they actually contribute to the performance of a system. And that's really, when I go into a new market, that's quite a deep investigation. And then once I understand the market, then I can develop systems more quickly sort of after that.
So how would you then, let's say there's a new market, I don't know, Saudi Arabia or something along those lines, and you want to maybe apply a trend following system to it, and you don't have any preconceived bias. So how do you go about doing a test on a market like maybe, let's say, Saudi Arabia, right? And to see what type of behavior, what type of pattern that you can exploit, right? Using a trend following approach.
Well, the first thing I do is I would ideally step back from the trend following hypothesis and say, okay, I think this market is valuable in terms of diversification for my portfolio. How can I profit from the way that market moves? So I'll start with a more generic approach. And I have some, let's call them generic strategies, very simple trend following, very simple mean reversion, very simple rotational momentum. And I've got a short side strategy that works across quite a few different markets. And I'll start with those strategies on a new market and I'll just test each of them and say, okay, well, does it look like there's any potential for that strategy in this market? And if there is, then I will do the work to investigate and dig further. But often I'll discard the idea of trading. For example, I tested quite a lot of ideas on the Japanese stock market. And I just don't have a good system for Japanese stocks. I'm sure there are good systems out there. I just don't have one. But I tested my generic systems on there. It's like, well, there's clearly nothing there. So I don't want to just try and optimize it and make it work. It should work in some way with a very simple generic strategy. And if it does, then I can investigate further. But if there's no edge and it clearly loses money, then I'm not going to take it any further because you just run the risk of over-optimizing.
Makes sense. Yep, that makes. Didn't thought of that myself. I think something similar to Andreas Kleno. He trades the futures market and he talks about market whether does he have a trending behavior or mean reverting behavior. So he's like, like what you just said, he does a very simple test, see what type of behavior this market exhibits, and then he dig deeper. Right? Oh, this market has a trending behavior. Let me apply some trend following strategies, etc. So let's say
exactly.
So I think I saw on your website you have this system called the US Slippery Dip, right? It's a trading system.
Yes.
Could you maybe give an overview of that, how that one works? I think it's a short trading system, if I'm not wrong.
It is a short trading system, and actually it's my favorite short trading system because it works across a variety of different markets. I have versions for US, Australia, and Hong Kong. And there's not that many stock markets globally where it's easy to short a very broad range of stocks. US and Hong Kong are actually two, which are quite neat for shorting. And also having the two of them on the short side adds a lot to the portfolio. So the basic concept is stocks are correlated, and when the broad market is dumping, stocks will also be dumping. And so what I'm doing is waiting for a clear downtrend in the index. There's a rally, and then it rolls over again. When it rolls over again, you know that there's downside momentum is continuing, and that means individual stocks are likely to be falling or accelerating downwards. So what I'm going to do at that point is short a broad cross section of weak stocks based on the index rolling over. When the index rolls over, we get short, and then we're going to ride them down. If any of the stocks show any sign of ticking up in the medium term, or the index starts rallying in the medium term, we're going to get out, because if the index starts rallying, we don't want to have we don't want to have a short squeeze on our hands. We don't want to have to you give back very quickly on the short side if you're not careful. And then the other neat aspect of it is on the short side, you can short sell a stock at 100. It can only go to 0, right? It can't go down that far. So generally on the short side, it's good to take profits. So I take profits relatively quickly on the short side, whereas on the long side with trend following, I don't have profit targets. I just let it run and run and run and run, because it can go from 100 to 1,000. But it can only go from 100 to 0 on the short side. So if you get out partway down, you capture most of the profit, you take the risk off the table. And so that gives a pretty neat risk-return profile. What's interesting is when you trade the short side in stocks, often the system on its own isn't that exciting. Like if I showed you the equity curve, you'd go, doesn't look that great. It makes single-digit annual returns, and the drawdown is, certainly double-digit, but it's negatively correlated to everything else in the portfolio. So it's making money when everything else is losing, and then when you combine them together, that's a beautiful thing. That's where the magic happens. So having the ability to make money from a bear market and combine that with, say, long side trend following, mean reversion, and rotational momentum has a huge impact on your ability to build wealth, to navigate bear markets without big drawdowns, and to basically smooth out your equity curve and make it psychologically much easier to trade.
Yes, I agree. And I think that's one of the biggest advantage that systematic trader have over discretionary trader, in terms of having multiple systems that could work in different market conditions, whereas a discretionary trader, they typically would do well in certain market conditions, and if they can't adjust quick enough or adapt, that's where they go into a drawdown and stuff like that.
Yeah, I think you also, as a discretionary trader, there's only so much ground you can cover, right? How many stocks can you look at in one night to find your signals for the next day? Maybe if you spend 4 or 5 hours, you could look at 20, 30, 40, 50 stocks in detail, right? But as a systematic trader, I can have 20 different strategies that each have between 1 and 30 trades within each strategy across Australia, US, Hong Kong, Canada, and crypto. And I can do it by pressing a button on the computer. So you can cover so much more ground. You can get much more diversification, keep your position sizes much smaller, and basically the trading becomes a lot easier, a lot safer as well.
It's a good ROI in terms of your time as well, right? Putting few minutes, and then you can just get everything up and running.
Yeah, I don't want to sound like it's easy. There's a lot of upfront work to do that. The execution is pretty straightforward, as you know. But of course, you've got to do the testing. You've got to build the confidence. You've got to establish the portfolio, figure out the weighting. So there's work to do. But once you've done it, the work is done. And then the computer, when you run the backtest to generate the signals, it finds the trades very, very quickly. Whereas for a discretionary trader, there's always a large volume of work to do to find the trades to fill the portfolio.
And since you trade a number of markets, US, Canadian and stuff, let's say a new trader, new to this, I don't think he's going to trade everything all at once. Which markets would you recommend someone new to start with?
Look, it depends a little on how much money you've got. As an example, the Australian market is not that easy to trade with a small amount of capital, because we have a minimum $500 trade size. And so you can't buy $200 worth of a stock to open a position. It has to be $500 or more. So if you only had a couple of $1,000, it's pretty hard to get diversification across Australian stocks. Plus, our commissions are a little bit higher than other markets. Like in Interactive Brokers, I think it's minimum $6 per trade now for Australian stocks. And $6 as a percentage of 500 is moderately high, right? Way better than when I started. I was paying $40 a side, $40 to buy, $40 to sell. That was hard. It's easy now, but it's still harder than, say, the US market where, $1 or $1 commissions or free commissions and not really any minimum trade size. So Australia is hard with a very small amount of money. US is easier. Hong Kong is very hard with a small amount of money because the minimum lot size for many stocks is big. Some stocks you have to buy 2,000, 4,000, 12,000 shares as a minimum lot size. And so the positions can be quite large. So you have to have a fairly decent size account to make that work. So the capital is one of the constraints as to which market you should consider trading. The other is, do you have a strategy that works? There's strategies for US, Canada, Hong Kong, Australia. There's strategies for all the markets that work, but you need a strategy that works. So to some extent, you've got to find a market you can afford to trade and a strategy that works, and then you've got a combination that you can start with. Most of my students, to be honest, start with either Australian stocks or US stocks. The ones who start in Australia typically have a little more capital, and they're Australian. The ones who have a little less capital usually start in the US.
And let's say, for example, someone like me, I trade primarily the US stock markets. And let's say I want to diversify. Which markets would you say is a lower hanging fruit for me to tackle once I have the US side kind of settled?
The best way to do it, I'll give you a direct answer to the question, but the best way to answer the question is to find some strategies for different markets and do a correlation analysis. And when you do that, you'll see out of all of the markets that you can trade, actually Hong Kong adds a lot of value to a US portfolio, for example, because the markets have quite different underlying drivers. Hong Kong, obviously, very China driven. US, quite different. Both are easy to short sell. So you can go long and short equities in both markets, which is really neat. Helps with the diversification, smoothing the equity curve. And I've found that when I combine those two in a portfolio, it makes a big difference.
Nice, thank you. That was a own question that I'm curious myself, and something to figure out, right? Yeah. So, okay, now let's maybe talk about crypto. So later on, right, we will talk about the specific stock trading system that you want to share with us. But for now, let's take a leap into the crypto markets and let's talk about maybe what are some concepts, right, that works in the crypto markets.
Yeah, it's a good question because, and the answer is the crypto markets have changed quite a lot over time. Yeah, so a few years back, there were a lot of fads, so there was the NFTs, and then before that there was, whatever it is. I don't really pay that much attention, but there were fads where certain tokens just took off, and trend following in those tokens with a very large profit target was hugely profitable. It was just insanely profitable. Now, at least over the last couple of years, there hasn't really been fads like that. And so what we're seeing is that strength in the large caps, let's say Bitcoin, Ethereum. So if you're holding them when they're strong and moving up, then you're going to make money. And then when the strength in Bitcoin starts to fall, then you're going to cash. So basically in and out of the strongest couple of coins based on momentum works now and works very nicely. Long-term trend following can work, but you don't really get the crypto returns, right? Because you've got to filter for lower volatility tickers to make the long-term trend following really work well. So you end up with more of a stock style of return in your portfolio. It's a little better than stocks, but it's not, again, like the triple-digit returns that you used to be able to get from the big fads and memes in crypto. The other thing that works really well, I mean, mean reversion just works beautifully in the crypto markets, particularly if you're very selective and you wait for very oversold conditions in a strong trend. So I've got a portfolio of crypto systems that trade basically each of those different concepts I've talked about. Relative strength in the large caps. There's a little bit of trend following in there, a couple of mean reversion strategies, and there's a short side strategy which works well in a big bear market. So again, all of those same strategies work, same as in stocks, but you've just got to adjust them to the personality of the market. I would say the challenge in crypto is that the personality of the market has changed a lot over the last 5 years and will continue to do so. I think with the introduction of the Bitcoin
ETFs.
and now Ethereum ETFs, Bitcoin has diverged from the altcoin market. And while I think there'll still be altcoin bull markets at some point, the market is clearly dominated by Bitcoin at the moment. Yeah, and holding Bitcoin has been super profitable. That's particularly recently, right? But holding a broad basket of altcoins, maybe not so much. So I think the ETFs have changed the dynamics of the market, and it's also very political now as well. What does the US president say about crypto, and there's a lot of big public figures in policy that affect the market, and some of them are pro, some of them are against. Whereas previously, the regulators were all anti-crypto in some way, or almost all of them. So I think that's shifting as well. So we need to be on our toes in the crypto market and really monitor: is the strategy still working? Do we need to turn it off? Do we need to adjust it? And I think that will continue for a while as the market continues to mature.
And for crypto, it's not like stocks where, the S&P 500, you trade the largest 500 stocks. Whereas crypto, you don't really have such index to say which are the basket of large cap tokens that you want to trade. So how do you go about defining which large cap tokens you want to trade?
Yeah, there's a couple of ways to do it. One is just absolute liquidity. Only trade tokens that have more than a certain amount of turnover on a certain exchange, or in aggregate across all of the main exchanges. So you make sure that you've got a high liquidity token. The other way you can do it is look at rank the tokens by liquidity or turnover, and say, okay, I'm only going to trade the top 5 or the top 10, and I'm going to hold those according to liquidity. If they break out, I'm going to hold them, for example. So that's another way to do it. You've got to be very careful because in the S&P 500, for example, you've heard of survivorship bias. If you develop a system, you have to take into account the fact that the constituents of the S&P 500 change over time. Yeah. In crypto, it's very tempting to say, oh, I'll only trade the top 5 tokens. You look at CoinMarketCap, you find the top 5 tokens, you get a strategy and you test it over those 5 tokens for the last 5-10 years. And it's like, wow, that made a fortune, right? But there's survivorship bias in there. They're the ones that became the biggest tokens. And you didn't know that 5 years ago or 10 years ago. And so we've got to be very cautious of choosing the current biggest tokens for our trading strategy, because the backtest will be inaccurate. It cheats because you're using survivorship bias. And also, they may not be the top 5 tokens in 5 years' time.
So how do you then tackle this survivorship issue?
Well, you've got to design the system so that it doesn't have it. There's no survivorship bias. So one way is to trade a broad universe. So basically trade every token on the exchange and have your system rules filter them out. Yeah. So we're not assuming that we're only going to trade the best tokens today, and our backtest doesn't cheat by looking forward to today and finding the best tokens. We know that we'll trade all of the tokens, and you just have a strong trend filter, a high liquidity filter, a volatility cap, and you have the entry and exit rules, and you just apply it to the whole market. So that's one way to do it. The other way to do it is to rank all of the tokens on a daily basis. So if you want to trade the top 5 liquidity tokens, you have to program your strategy for today, what are the top 5? Now, take your rules and apply them to that top 5. Tomorrow, rank all of the tokens, find the top 5, apply your strategy to the top 5. So you've got to sort of redo the ranking every day if you only want to trade the big ones, because the top 5 now are different to the top 5 years ago.
And going by what you said, then is how do you then backtest this using this approach? Since when you backtest, they wouldn't know what's the top five, like, I don't know, 10 years ago.
Yeah, it's a much more challenging coding exercise, to be honest. I mean, it is doable, because basically what you have to do is get the code to look on each day of the back test, do the ranking, right?
Okay.
On every single day of the back test, and then based on that ranking, you can then make your decision. So, that's harder,
Yeah.
not impossible, just harder. The simpler solution is to use the broad basket and just
Got
have
it.
your rules filter out the junk, too gappy, too volatile, not trending strong enough, that sort of thing.
And where do you get crypto data? I know for stocks, I know a lot of people use Norgate, but what about crypto?
Yeah, so for crypto, for trading, I use the data straight from the exchanges. So I'll download data from Binance, I'll download data from Kraken, from KuCoin, etc. And I just have an automatic downloader that pulls that data. It's in CSV format, and it goes into Amy Broker, so I can do the backtesting there. That goes back only so far, because basically the exchange will have data from when the exchange listed each token, which is maybe not the whole life span of that token. So you can buy other data sets separately that different companies have aggregated over time from different exchanges and different data sources to make a longer term time series. Unfortunately, that data tends to be expensive. So for example, I paid $450 a month for the data subscription for the crypto data. I'm not comfortable I don't want to plug that company, so I'm not going to mention it by name. Not that there's anything wrong with the company; it's good data, but it's a high cost subscription, and I feel like it's a bit highway robbery, to be honest. So, yeah.
Okay, understand. And for stocks, when you said you're trading Hong Kong stocks, does Norgate provide Hong Kong stocks? I can't recall.
No, it does not. So
Okay.
Norgate provides US, Canada, Australia, and I think that's all they're going to do in stocks. I don't think they're going to expand to any other markets. And so that's great. I use Norgate for those markets because it gives you delisted stocks. It gives you the historically accurate index constituents, which is important for backtesting strategies like on the S&P 500 stocks. You need the historical index constituents. For Hong Kong, I use Metastock data. And Metastock is neat because for one subscription, which is actually pretty cheap, you get every single stock market in the world. So all stocks currently listed. But that's the catch. It's currently listed. So you don't get delisted stocks, and you also don't get the information on index constituents. So like, let's say what stocks are in the Hang Seng index, it's like, you know today, but you don't know 5 years ago. And so outside US, Australia, Canada, I don't have any strategies that trade stocks in an index. All of my strategies trade the entire market because you have to. You can't backtest a strategy that trades only stocks in the index unless you've got the historically accurate index constituents. And Norgate is the only data provider I'm aware of that provides that. And it's only for Australia, US, and Canada.
So for the US stocks, do you do a backtest from 1950s, or you take into account the more recent years?
Look, generally no. However, I like to understand what happens during different economic conditions. So, inflation up, inflation down, high interest rates, low interest rates rising, interest rates falling. These things, it's important to understand how stocks move in different macroeconomic environments. And until recently, most of our lifetime, what were interest rates doing? Falling, right? And then they started to go up post-COVID, but we didn't really have a lot of data to say how would the different markets behave when interest rates were rising and or high, or when inflation was out of control. But if you go back a little further in history, then you can see what happened to the stock market. And I think I think that can be useful. I have a trend following system for US stocks, and it's not my best strategy, but it's a good strategy. It's solid, right? And I think it's valuable. But the great thing is you can test that back to 1950, including all delisted stocks, and it worked the whole time. just like grinding up, right? So didn't shoot the lights out. It's not making like 30% return per year, but it works. And that gives me a lot of confidence. It's like no matter what happened, interest rates up, down, inflation up, down, war, famine, pandemic, it worked. And I just think more data is better than less.
And what if, let's say, a mean reversion trading system, it works the last 20 years, but if you dig back further to the 1960s, 70s, it didn't work. What would then be your take on that?
Yeah, it won't. Look, quick hint for everyone listening is mean reversion strategies generally won't work back that far, at least not in my experience. I think the market dynamics have really changed a lot over time. And so you've got to look at the nature of the strategy and say, okay, well, how long do I expect this type of strategy to survive? And I would say a trend following strategy should have a long lifespan. Yeah, trends exist. They've always existed. They will continue to exist. And so a simple, robust trend following strategy should work over decades. You might have to tune it up and whatever a little bit, but the way the market moves in the short term has changed so much. Liquidity has increased massively. The size of companies has increased. High frequency trading and exchange rules, all of that changes over time. And that affects short-term strategies much more than long-term strategies, I would say. And so generally for mean reversion, I'd be looking at much more recent data. Yeah. And just to be clear, I don't optimize and fine tune a trend following strategy on old data, like back post 1990 sort of thing. That's just for validation and understanding of, okay, what could happen if certain economic conditions emerge.
So when you talk about trend following strategies that, seems to be robust, right? What about earlier you also spoke about relative momentum. How does that hold up during, the 50s and 60s?
Actually, it's a good question. To be honest, I haven't taken a rotational momentum system all the way back. I'm going to do that for homework after this call.
Sure. And yeah, so we were talking about mean reversion earlier. So I think now's a good time. Maybe I think you've prepared some presentation slides for us to talk about a mean reversion trading system. So Adrian, right, let's, see, what you have prepared for us, for the viewers, to learn a simple mean reversion system that they can, take into account and use. Okay.
Yeah, let me share my screen here. So what I'm going to do is I've called this presentation. It's not really a presentation. I've got some slides basically talking through some concepts. But what I'm going to do is draw out some lessons from a mean reversion system. I'll talk about kind of what the system is, how it works, and show you some trades and some individual lessons that I think are useful for people to hear. And then I'll show you how you can show everyone how they can get the rules, the exact rules for it later on. Awesome. Is that okay? Sound good?
Sounds good.
Okay, great. So lessons from a mean reversion system. Let me come over here. So first I'm going to show you a backtest for this mean reversion system. Now, just in case anyone is not familiar with backtesting, what this means is you've got your trading rules. This is a system, which means it's got absolute rules. If certain things are true, you buy. If certain things happen, you sell. And so those rules have been coded into, in this case, Amy Broker formula language. And I've applied those rules to every stock in the market over the last 30 odd years. Now, in this case, this is applied to the Canadian stock market, including delisted stocks, right? So had we followed this strategy over the last however many years, the chart on the left is the equity curve. That's that's how the performance would have looked. The chart on the right is the drawdown profiles. This is how big a dip the strategy would have had in your account. So you can see in looks like about 2008, the biggest dip here in the account was about 9%, and that would correspond over on the left-hand chart to this dip here, which was right at the start of the global financial crisis. So as the market turned in the global financial crisis, this system had a few trades on, but then eventually it went to cash and just waited until the bear market was finished and it started trading again. So this is the performance of the system. And it looks, it looks pretty good. Bottom left to top right, it's kind of a relatively straight line. There's some rallies and there's some flat spots, but it's a system that has clearly worked over time, right? So how does it work? What are the rules? Well, first of all, there's a trend filter. The trend filter basically says we only want to buy stocks that are trending up. If we're going long, we only want to do it on stocks that are trending up because that just gives us an increased edge. There's a volatility filter. Volatility filters are important for mean reversion because higher volatility stocks tend to perform better with a mean reversion strategy. You get a bigger move, higher average profit per trade, more chance of overcoming the cost of slippage and commission. So we're looking for high volatility stocks here. Liquidity. Liquidity is important. We need to have enough liquidity to get in and get out of the system really easily. So here, the average daily dollar value, dollar turnover is $1 million or more per day. So you imagine if a stock trades $1 million per day, if you're trying to get in and get out with a $5,000 or a $10,000 position, it's pretty easy to do it without much slippage. But if the stock was only turning over $100,000 a day and you're trying to get in and out with $10,000, a $10,000 position, slippage can become a real problem. And for mean reversion, that's critical because mean reversion, we've typically got small average profit per trade, and we can't afford to have that eaten up by slippage and commission. We need to make sure that we've got high enough liquidity so we can get in and out and preserve that small edge that we've got. The next rule is price. So we want to filter out very low priced stocks. And that's useful because in the Canadian market, you pay commission as a certain amount per share that you buy. So if it's a 10-cent stock, penny stock, then you pay the same commission per stock as if it was a $100 stock. And obviously that's a higher percentage on the 10-cent stock than it is on the $100 stock. So we want to trade slightly higher price stocks. In this case, I've got the minimum price filter set to $5. And then there's an entry. And the entry is a fairly typical mean reversion entry. It's a oversold RSI. In this case, it's a 3-period RSI hitting a very oversold level. So when the stock has tanked heavily, we're going to buy in anticipation of a bounce. And then there's 2 sell rules. One which gets you out if the stock bounces just a little bit above a short-term moving average, and one which gets you out if the stock continues to go down and crosses below the long-term trend filter. So generically, these are the rules. Now, listeners can get access to the exact rules. I just didn't want to burden people on the show with all of the technicalities of what the rules are, because the lessons I want to draw out are irrespective of what the exact rules are. So I didn't want to be distracted by the technical rules. In any case, people can go to enlightenedstocktrading.com/free and download these rules for themselves so they can get the exact rules. All right, so let's talk about some of the lessons from this. Does that make sense, or do you want to ask some questions before we go on?
Crystal clear to me.
Crystal clear. All right. So I ran a backtest, and here is part of the backtest results. And the first thing to point out is that the annual return was 7.34% per year on average. And a lot of people will look at that and go, oh, well, that's not much money. I could have got better returns doing X, Y, Z. Why would I trade that system? The annual return is low. And this is a mistake to think that the return of a system is low, therefore it's not a good system. Because in this system, the return is low, but the exposure is very low. The exposure is only 1.45%. So what that means is that it's only invested 1.45% of the time. The rest of the time it's in cash waiting. And so the return per unit of time invested is really good. We make great returns when we're invested. Otherwise, we sit in cash. Now, the cool thing about that is we can then combine this with several other strategies very, very easily. Because this doesn't use much capital, we can add it to another strategy that doesn't use much capital and another strategy that doesn't use much capital and stack them on top of each other in a portfolio, and our returns start to grow. The absolute return of any individual system doesn't matter that much. It's how much value does it add to the portfolio of systems. That's the important thing. I find that a lot of traders will look at a strategy on its own and go, yeah, it's not really good enough for me to trade. I'm going to pass. But looking at a strategy on its own, it's a huge mistake. We should look at the strategy in terms of how it can contribute to our portfolio strategies, not look at the strategy in terms of how good is it in isolation. Does that make sense?
Yep. I think the way I look at it is like, we have 24 hours a day. You can spend, maybe a strategy, you spend 20 hours a day working to make $500. Or would you rather spend 5 minutes a day and you make maybe, let's say, $50? $50 is smaller than $500, but you only spend 5 minutes a day spending that $50.
Yeah. And if you have 20 different ways to make $50 at different times during the day, you end up making really good returns for very little effort.
Yep, exactly.
And so this is how I think about trading. And I can't tell you how many times, I mean, I know you get it, right? But I can't tell you how many times I've had a conversation with a trader about a system and they've gone, oh no, I don't like that system. That's not good enough. I want a better system. Like, whoa, hang on a minute. You're thinking about it all wrong. And I think this is the magic. If you can get, if we can get our heads around this, it's then a very short leap to creating a portfolio of strategies that work really nicely together. Yeah. So I think that's the first lesson I wanted to call out. Just because a strategy has low return doesn't mean it's a bad strategy. Actually, another good example of this concept, you asked me about the slippery dip system. That system has a very low annual return. It's about, I think my version of it's about 8 to 10% per year compound return. But it makes all of that return during a bear market. And during a bull market, it's completely in cash. So you can combine that 8 to 10% return per year from bear markets with alongside trend following system that makes money in bull markets, and they don't overlap because the trend following systems in the market in a bull market, the slippery dips in the market in a bear market, they can use the same capital. So the returns are additive, which is kind of magic, really, when you think about it.
Yeah, it's like maybe let's say you have a long only system that does 15% a year, and this one, let's say the one you shared earlier was 8%, so it's like 15 plus 8, 23% annualized return a year.
Yeah, absolutely. And lower drawdowns as well.
Oh,
so
yes.
Combining systems is the magic, 100%. Okay, what's the next lesson? So this system doesn't trade very often. You look at the equity curve, there's long flat spots. You can see flat spot, flat spot, flat spot, all the way up the equity curve. And on average, it only had about 13 trades per year. So the lesson here is this is going to be really boring. If this was your only system and you're only taking about 13 trades per year, it's going to be very hard to maintain focus and attention and do it consistently. So this sort of system is really great for automation because the computer doesn't get bored. So my automation runs every day. It just updates the data, runs the backtest, places the trades, and reports the results. That's gold because I can have a whole bunch of systems that don't trade very often and combine them together into a portfolio. And I don't have to worry about having the discipline to follow those systems every day. Yeah. Some systems are very boring to trade, like this one, but it doesn't mean it doesn't work. So that's the sort of lesson 2. One system in isolation, it might not be very exciting to trade. So combining it into a portfolio will give you more activity, and that'll make it more interesting in your day-to-day operations. Keep you focused. But automation really, really helps for systems like this. Okay, now I've got some trades that this system generated. So I thought I'd show you the chart and then just talk about the lesson from that chart. Make sense?
Yep.
Okay, so here's a stock trend that this is a profitable signal that the system picked up, and I've just picked this signal at random out of the backtest. And you can see it's a strong uptrend. It's pretty volatile. And then the stock corrected very sharply. We bought right at the low, and then we sold a couple of days later. The best trades from a mean reversion strategy are often the most uncomfortable. So after several very heavy down days and a big gap down, the system says buy. That's not going to feel good. That's going to feel like trying to catch a falling knife. But what I've learned is that the vast majority of the time, my best trades didn't feel good putting them on. And this is true in mean reversion, and it's true in trend following, and it's true on the short side. They don't feel good, but that doesn't mean they're not profitable. And so here, our lesson is we've got to be really careful to not let our emotions get in the way of the system, of the strategy. We've got a system, we've back tested it, we've proven that it's profitable, we've built confidence in it. Now we need to follow it. And if you hadn't have taken this trade because it really looked like the stock was going down and it was going to keep going, then you would have missed out on a big profit that happened very, very quickly over just 2 and a bit days. So we've got to take the signals even if they look uncomfortable. Here's another one. This stock had a very long strong uptrend this is in 2024. You can't see the numbers at the bottom, the scale at the bottom probably, but that would have been a pretty difficult trend trade because the stock was very volatile and most trend following systems probably would have kicked you out. But we do get large retracements pretty frequently in strong trends. And you can see on the left-hand side, this is the trade. So we've entered after this very strong retracement. We bought right at the bottom. The system gave us this signal. And then a couple of days later, we sold out here. And if on the right-hand side, I've just zoomed out on that chart. And again, this is a trade where you looked at it and you thought, oh, that trend is over. At this point where it's highlighted in green, you would have thought, very likely on the day of the signal, that would have been pretty scary to take because the trend line is clearly broken and it's been very volatile. It's gapped down a couple of times. You're not going to feel good taking that trade. But this is a very common mean reversion trade that tends to perform well. Doesn't feel good, but after a very heavy period of selling, the market does tend to bounce just a little bit and you can get out and make a profit. So this was a moderately good trade, but it would have been scary to take as well. Here's another one, and this is a really important lesson. This stock rallied really hard and then rolled over and collapsed. But the first wave of the collapse was a sudden sell-off, and then it bounced and collapsed again. And as the stock sold off heavily the first time, this system got an entry, a signal to enter. So it bought long right at this low here at the open. And then 2 days later, it rallied and we got a signal to exit. A lot of people at this point are going to be hoping it comes back to previous highs because maybe that was just bad news. Maybe it was overdone. Maybe it's not over. What if it keeps going? What if it takes the next leg up and I don't want to miss out? So it's tempting to not take the exit. And so here, the lesson is you have to take the exit because this is the strategy. It captures small bounces. We can't turn it into a trend trading strategy because that's not what it is. If you don't take this exit, you would have ended up holding all the way down. And psychologically, that's very, very damaging, but easy to do. So the lesson out of this one is if you get an exit, take it. Take it on time every time, right? Because if you don't, who knows what pain you're going to end up finding yourself in. Yeah? What else we got? Okay, here's an example of a losing trade, right? This stock was trending up. Couple of weeks, it went down very, very heavily, and we got a signal to buy. But sometimes in mean reversion, you buy the dip. It does keep dipping, right? You've seen the meme online. I bought the dip, but it kept on dipping. That does happen, right? So what do we do about that? We can't predict which ones, which trades are going to keep dipping and which trades are going to bounce and give us big profits. We just don't know in advance. You only know after the event. So the way you resolve this is firstly, understand what's possible, right? So do the back test, look at all of the worst trades and see what can happen. That's the first step. Second step is run the back test. Run the back test and look at your position size. And what you'll see is that if you size too aggressively, trades like this really, really hurt. But if you have a broad portfolio where you're sizing very conservatively on each individual stock, a trade like this doesn't hurt that much. And so the big lesson is size small, smaller than you think. Make sense?
Yep.
All right. Then we got another loss. This was a good one. So the trade bought here. So the system bought here, and the next day, the stock dumped, and it had a really long lower wick on the candle. And if you had an in-market stop loss, this trade would have been really, really bad. But often the market overreacts during market hours. And so on this sort of system, I really don't like to have an in-market stop loss. I rather have a next bar on open stop. So if it gets touched today, we get out next bar on open, because that way I'm not locking in the extreme of emotion that's happening during the trading day when the market is really collapsing. Often overnight, there's a bit of a breather. People go, "Oh, it wasn't that bad." The stock tends to recover a little bit, and you can get out at a better price. That's not always true, obviously, But if you backtest a in-market stop versus an next bar and open stop for every strategy that you use, often you'll find that a next bar and open stop is more profitable. And I think that's useful information to know. Is this useful?
Yep, it's really insightful. Thank you.
Yeah. Okay, cool. Here's another losing trade. This was a 20.5% loss. So we had a big decline, and then the market gapped down, and the system bought. That was a pretty reasonable entry, but it kept going down on the day of entry. So there's a red candle. We entered at the open. It kept going down. So it wasn't the perfect entry. And the market did rally the next day. And so we got out. But sometimes the rally is just not big enough to give us a profit. And if we'd have just held a little longer, you could see there's this big green candle. That would have been magic. But the system already got us out. And I think the lesson here is FOMO is really a big problem for traders. You could look at this and go, I should have held on. Next time I'll hold on a little bit longer and just see if it bounces a little more. That way I'll make more money, right? This is the emotional rationalization that's going on. But if you did that and you held on a little longer, what would have happened on this trade? We would have ended up down here somewhere waiting for a big bounce. And so we've got to take the exit and then not worry about what happened after the exit. Like, the system doesn't know, the system doesn't care. It just got out. So, I don't want to say never. I very rarely look at the charts of stocks that I've exited. Why? Because I'm out of it. I don't want to have that emotional reaction to, shoulda, woulda, coulda. I'd rather just follow the system and move on. It's emotionally much, much easier. What else? Oh, here's a good one. This shows you the time between equity highs. So the system made a high, and then how long was it before it made a new high above that level? So basically, how long do you have to wait to feel like you're making money? Yeah. And I think the lesson here is interesting in that as people in the non-trading world, we're trained to go to work, get paid, go home. Go to work, get paid, go home. But the market's not like that, obviously. The market gives us money, takes it away, gives us money, takes it away. And sometimes we go to work in the market for months on end and we don't make any money. The market doesn't pay us. And we have to learn to be okay with that, because we have to keep doing it so that eventually we can come out the other side and go on to new equity highs. And this is one of the powerful things about backtesting, right? If you didn't backtest your strategy, how would you know that there could be this many months from one equity high to the next? You wouldn't. You'd be getting 5 or 10 months in thinking, this is not working. I'm not making money. Maybe I should do something. Maybe I should go get a job. Maybe I should do something else. But if you test your strategy, you know what's normal, what's possible, what's happened in the past, and that's really powerful knowledge. So we've got to be patient and be willing to sit through flat spots and drawdown. I also looked at the distribution of trades, right? So this is a histogram plot of how often or how many trades there were in the backtest in each of these different buckets. And this is a mean reversion strategy. So most of the trades are in the plus 5 to 10% profit bucket, right? There's a few trades in the minus 45% bucket. And we should look at this and go, okay, every now and then there's going to be a trade that cuts in half where we have a 50% loss or more. And we need to be prepared for that. We need to accept that that's real. We need to accept that with enough time, that's going to happen to us, right? And so, we need to position size and manage our risk accordingly. So we don't bet the farm on each trade. We don't use a little leverage, because if one of these bad trades came along, it's going to wipe you out. But if your size small, it doesn't matter. This one's interesting. I think this is the last one. It shows the time in trade, where this column here is 1 day in trade, all the way up to 10, 11, 12, 13 days in trade versus profit. So with mean reversion, the most of our profits come from very quick trades. And then the trades that drag on for longer and longer tend to be losing trades because they haven't bounced, they're just dribbling down. And so often with a mean reversion strategy, it's really useful to have a time-based exit that just says if it hasn't bounced after 5 days or 10 days or 12 days, just get out because it's not going to bounce. The signal has passed. We now need to just cut our loss and move on and go to the next trade. Yeah. So a few good lessons out of backtesting this strategy, which I think are really powerful. I do have the entire rules for the strategy. I just didn't want to, as I said, I didn't want to burden the whole conversation with this indicator and that indicator. You can scan the QR code and get the complete code fully coded for you in Amy Broker formula language, so you can backtest it for yourself and play with it. So I think that hopefully that's useful anyway for the group.
Yep, it is. And I also put it in the link in the description below the video. So people who don't have the QR code or whatsoever, just go to the description. You should be able to find the link to access the rules. Yeah.
Brilliant. So, I mean, that's the strategy I thought I'd share. What do you think? Questions, comments?
Yeah, so that was very insightful. Thank you for that, Adrian, and definitely quite a bit of preparation on your part, right, to actually deliver that short presentation. So thank you for that. Question that comes to mind, it's just one point to add, right, where you mentioned earlier that some of the best trades are the most uncomfortable trades. And I really can relate to that. I remember COVID, stock market dropped 30%. And then one of my momentum strategies says it's time to long because the V-shaped recovery was very fast. Gosh, I didn't want to click the buy button, but hey, guess what? System says buy. Okay, I'll just buy just before the all-time highs where, who knows, you could double top and goes back down lower. It bloody paid off, man. I'm sure you know, right? Just went up. So so I can really relate to that. I think even for discretionary traders, I'm not sure how discretionary traders you guys can take into account the uncomfortable feeling that you have. But if you maybe journal your trades, you realize times where you feel the most uncomfortable. Those are usually where your trades really do pretty darn well in that circumstance of your feeling. So that was a very good point that clicked with me. Yeah.
My solution to that is automation. I know myself enough to know that my emotions will get in the way if I let them. And so I found a lot of benefit in just automating all of my strategies. The capital allocation is automated and it just runs and I monitor everything. So monitoring is far easier than executing, right? And so, I've basically got myself out of the way and I develop strategies, I plug them in and then I monitor them. And that helps a lot too.
Speaking of automation, maybe could you give me an overview of how the automation works? Because I think that you just a few clicks a day and your system just kind of like run on its own. Did I get it right?
Well, not even a few clicks. It's fully automated. So the way we developed our API and automation engine, so it replicates what I would do, right? So the automation application will update the data, open Amy Broker, run the back test, find the signals, talk to interactive brokers, find what trades I've got on, place the exits, size the entries, place the entries, report back what trades it took and what the current positions are, and then close down Amy Broker and turn off. So the whole thing happens, and it will look at the account balance in the net liquidity in interactive brokers, and it applies the capital allocation percentages to all of the different strategies and then automatically does the sizing and everything. So everything I previously did on a spreadsheet, it does. And the great thing about that is I can now diversify far more broadly than I would want to if I was doing it manually, because I don't want to do so much work. I'm a little bit lazy. It's not that I'm lazy. It's just that I've got other things to do. I prefer to talk about trading than to click buttons and place trades. That's kind of boring. I like to develop systems. I like to work with traders. And so I spend a lot of time doing that. I don't really like to spend a lot of time just placing trades. I rather the automation does it. The other thing is I found that, as your account grows, I became more and more concerned about, risk, like external events, power failure, internet failure. I get locked out of the house. I'm away on holidays. My laptop gets stolen. These sorts of things start to become very troubling, right? And it all really came home to me one day when this was just before I went live with my automation. I pulled up at the house, pressed the garage door opener, nothing happened. Power was out. Couldn't get into the house. Computers in the house, laptops in the house. So, okay, I haven't done my trading for today. This is a problem, right? And so it's like, clearly I need a better plan. So the first plan was to have a key instead of a garage door opener. So I implemented that plan straight away. But then beyond that, it's like, well, clearly things can go wrong. I need to make my trading a bit more robust. So I put it on a VPS, a virtual private server in the cloud. All of the software is up there, always on, backup power, backup internet, and it will run whether I have access or not, whether I'm in Australia or Bali or Africa.
Nice. It's like a ATM machine that just keeps printing money, right?
Look, if only that were true,
year
right?
after year.
Yeah, I mean, if only that were true. It's not the magic plug in the algo and get rich. Like, obviously, tongue in cheek, but it's not like that, because you have to monitor it. Automate. Kevin Davey, who I'm sure many of your listeners know, he says automated trading does not mean unattended trading, and I think that's a really great saying. Right? We have to monitor it to make sure it's working. We have to check the trades are executing right. We have to stay on top of the performance of our strategies to make sure they're still working. Nothing's going wrong. The drawdown isn't too big. So we have to be attentive. Anyone who tries to sell you a plug-in algo where you just say, plug it in, put your money there, you'll get rich, that's a scam. That's not real, obviously. Automation just makes it easier to have discipline and easier to be consistent. And I think that's key. And it also unlocks a level of diversification, which is very, very hard to achieve if you trade manually.
And from what I'm hearing is there's this automation engine you mentioned. It's kind of like a robot that replicates what would you have done. You would click this, open this file, calculate position size manually in Excel. It kind of like does all that for you automatically, that particular software, whatever you call it.
Yeah. So it's a Python program. It's been custom developed to do basically all of those steps. It opens Amy Broker, it updates Norgate, it refreshes all of the watch lists and everything, opens the batch file. It has all of the systems in it, runs them, gets the results, does all the calculations, everything. Yeah.
And because you trade like multiple systems across different time zones, you need to update your Norgate at different times of the day as well. I'm guessing that's
absolutely. Yeah. So it'll run the Norgate update before each system that it runs to make sure it's got the most recent data. It'll also update the Metastock data and run that. So I've downloaded for the Hongkong, which I use Metastock for, and it'll pull that into the Amy Broker database. So yeah, basically we've developed it to automate all of the steps that a systematic trader with Amy Broker and interactive brokers would do. All of the steps that we would have to take.
Nice, because right now I'm not automated. I'm still like I have to spend like 5 minutes a day doing that clicking. So whenever I'm overseas, I got to say, darling, what's the time? I've got to be there for the market open to do my clicking, right?
Yeah.
At a hotel, Wi-Fi, I need all this.
Yeah. So we had this problem. We had this problem, right? And my wife tells this story because my wife is involved in our business as well. She's does a lot of the psychology coaching. She's a high performance coach. But anyway, she bought us a weekend away for my birthday one year. And we were driving. I was like, I've got to do my trading. Are we almost there? Oh, no, it's like so far. It was a surprise, right? And I said, okay, I can wait. Is there Wi-Fi? Oh, I don't know. Didn't check. It's like, well, because it was a long weekend. It was Friday, right? And ended up being no Wi-Fi. So it's okay, well, I'll attach my computer to my phone. I've sort of got a cell phone signal. That sort of thing was horrible because, I've also been driving down the freeway, not driving, but in the passenger seat. It's like, okay, I've got to do my trading because we're not there yet. We're late with traffic. So, cell phone signal, laptop, trying to get it working. I mean, that's not the way to run a trading business, right?
Yeah.
So we had a similar thing, but now automated, right? Last year, my son and I went to Africa. We climbed Mount Kilimanjaro together, and I didn't even take a laptop. I just took my phone, and the VPS in the cloud runs the trading. I'll get, local cell coverage. I just log into my VPS on my phone, check everything's working. I get the email notification. So I was away for a couple of weeks, didn't even have a laptop.
It's amazing. So, wow.
Yeah. I mean, it's a different level. It's just, I mean, I think she loves automation more than I do, because now, we don't have to rush back from the beach in the morning. We go out for breakfast very often down to the beach. And I used to have to rush home to make sure that my trades were going in right and everything. Don't have to do that now. And we go away, don't have to worry about it. I resisted for a long time. It's like, oh, my trading only takes 5 minutes a day. Like, why do I need to automate? It's only 5 minutes.
But it's every single day.
But it's every single day. Exactly. Right? And so the automation, honestly, I say to my students, it's life-changing. Like it really is. And it's not because it makes you way more money, although it does help because it reduces mistakes. But it just, that worry, like, oh, my laptop's not starting up, or, oh, I'm overseas, or, oh, well, I have internet, or, oh, I'm stuck in traffic. All of that goes away, which is, whoa, that's next level.
Yep, next level. And maybe just to touch a little bit about risk management before we conclude today's session. So you trade multiple trading systems across different markets. So how do you then manage this capital allocation across these different markets and systems?
Yeah, solid question. I think it's really important because it's a complicated decision, right? How much money do I put into each system? How much risk do I take on each trade? So the way I do it is I let the numbers tell me. So I run a backtest for all of my strategies, and then I have a model which pulls all of the equity curves together in different weightings. And so I can say, okay, let's give this one 5%, this one 10%, this one 1%, this one 15%, and see how they would combine together. And that model takes into account returns, but also exposure. So what you can do is say, okay, if I have 50% this strategy and 50% that strategy, you can see, all right, how much money would I have made? But also you see, oh, they don't use their money at the same time. So there's a lot of cash sitting around just wasted. So I can add another strategy that uses cash when these strategies don't use cash, and I can give that a bit of a weighting. And you can play with the capital allocations to find the best combination that meets your objectives. So I do this. Amy Broker can't do that, so I do this in Excel. There is software that can do it. So, for example, in Realtest, you can combine multiple systems together. But I've got a lot of legacy in Amy Broker, and it's all working, so I'm using that primarily. So I'll combine the different systems. And what's interesting is it'll often be surprising when you'll find, oh, this strategy adds a lot of value, but it didn't look like a very good strategy. Like my short, we talked about slippery dip earlier, low returns, high drawdown, doesn't look very good in isolation. But because of the negative correlation, you can see, oh, it should have quite a high weighting, quite a high capital allocation, compared to if I just add another trend following system, that would have quite a low capital allocation. And the model will tell you that. So.
And when do you decide to maybe stop trading a trading system?
Yeah, I mean, again, that's probably one of the biggest challenges that systematic traders have is when do I turn it off, right? And the best way I found to have that is to have absolute rules going when you start up a strategy. All right, I'm going to turn this off if this, or this happens. A lot of people don't have that. So what I will also do is monitor a system on a very regular basis. So I'll run a back test of all of my strategies. So I have a batch file in Amy Broker that runs 57 strategies. So it'll back test all of them. I don't trade them all, but I monitor them all, right? And so it'll spit out the equity curves of all of those strategies. And I can quickly look through and say, okay, how are they all performing? I can look at the recent performance stats. And if the drawdown is getting beyond what is historically normal, I'll have a really close look at it. If it's had a lot of losing trades in a row, I'll have a really close look at it. If the average profit per trade is dropping compared to the original backtest, I'll have a close look at it. So basically, on a regular basis, I'm investigating, is this system still good? And then I'll look to turn it off if it's not. Most of the time, it's just yep, it's okay. Yep, it's okay. It's tick the box. Every now and then, I'll look a little deeper, and then every now and then, I'll turn something off.
Right, got it.
What's just one last thing. What's interesting is the more strategies you have, the more diversified you are, the easier it is to turn something off. If you have only one system as a trader, it's like, oh, it's my only system. If I turn it off, I'm not a trader anymore, right? But if you have 20, turning one off, you're still a trader. It's okay. That's just a bad strategy. Just turn it off, put a new one in.
Yes.
So many people cling to their one or two strategies they love, but that actually makes it much harder, because what if one of those strategies stops performing well? You need to
You get overly attached to it then.
Yeah, right. Exactly.
It's like having a 20 girlfriend and one girlfriend. If 20 girlfriend, one leaves you, hey, you still got 19, man. Come on.
It's not like that at all. That's stressful. 20 systems is not stressful. 20 systems help you sleep at night. So I'm gonna beg to differ on that example.
And where do you get new trading ideas to test on?
Yeah, look, a lot of places. I spend a lot of time looking at charts, just because I kind of debrief what's happened in my trading. I look at different trades from different systems, and that stimulates ideas. I have a subscription to technical analysis of stocks and commodities, so I kind of every now and then I see some ideas in there. I look at lots of trading websites. I have spent a fair bit of time on your website. I look at Kevin Davey. He's a great example of good system developer. I really like his stuff. He trades futures. I trade stocks, but some of the ideas are transferable. So I look at competitors like other educators, other traders. I look at Twitter. A lot of people are just sharing ideas on Twitter. A lot of them are not good, but it stimulates ideas. What else? Books. I've got a lot of strategies from books over the years, and a lot are no good. Like they used to work, but they don't anymore. But that then sparks new ideas. I think the best one is, looking at charts for yourself. Okay, what sort of move is happening on this chart? How could I capture that? And could I capture that over and over again? And if I put that into a system, would there be enough positive moves to offset the negative moves? I really like the creativity of that process.
Okay. And we're going to move on to the closing section now. And maybe this question is something that I'm curious about. What are some formative moments in your life? It doesn't have to be trading, right? So what comes to mind? Maybe I can talk a little bit first, right? While you have some time to think. So for me, I think one of my formative moments is in Singapore, all of us have to serve the army. So I was enlisted into commandos. But pretty brutal 2 years, but it taught me a lot about discipline.
Yeah.
It taught me a lot about perseverance. It taught me a lot about mind over matter. And basically equipped me with all the traits to handle trading now today. So I don't know, looking back, maybe I was destined for this, right? So that was definitely one of my formative moments, right, during the 2 years. And during the 2 years, I hated every moment of it. But looking back right now, I'm glad I went through every moment of it. Funny how life, teaches us new things.
Yeah, wow. That's such a good one. And I've actually, I've heard that from a few people that military experience has done that. We don't have military service in Australia. Look, a big one for me was my university studies. I studied chemical engineering. It's not an easy course. In fact, there's some subjects there that are incredibly difficult. And I saw a lot of people really struggle. And the people that struggled didn't ask for help. And I was pretty good at asking questions and putting my hand up and looking stupid in front of 300 people and on all of that. But I saw this big divide between the ones that learned and grew and the ones that really fell behind and struggled. And I think observing that was one big thing. And when I'm working with trading students now, at the beginning, before I even accept someone as a student, one of the most important things is I make sure they have to be willing to ask questions. They have to be willing to look dumb. They have to be willing to admit they don't know, because you'll never make it if you don't. And I think that's true of many things in life, right? The people that succeed are the ones that are willing to keep going and ask and ask and ask and ask until they get it. The other part of university which really got me is I thought I was pretty smart, right? I did pretty well at school, and I got into a good course. I got a scholarship and all of that, and that was great. But I got in, it's like all of a sudden I wasn't the best anymore. There were people who were way smarter than me doing the same course as me. I was thinking, oh, it's a bit confronting, right? I thought I was pretty clever. And so I sort of accepted that. and I went through the first couple of years. I was doing well. I was trying to do well. But then I set myself a real goal, like a really clear goal. And it was absolute. So my goal was, I want to get the university medal, which means I have to come first in the course. And not just first in the course, but do really well. And I basically decided that at the end of second year of uni in a 4-year course. And at that time, I was nowhere near it. There were people that were getting way better grades than me. And even though I was doing well, but that clear, absolute goal, it was absolutely measurable. I was either going to get it or I didn't. There was no in between. There was no shades of gray. And it was time bound, obviously. You know, at the end of the course, I have to be first, right? And so that was a really great goal. It was a really big goal. And I really wanted it. I don't know why I wanted it. Like, it doesn't really mean that much, but I just decided that's what I wanted. And that was my thing. And that's what I'm going for. And I didn't even tell anyone, right? I just decided internally with conviction that that's what I wanted. And, you know, long story short, with a goal that big, that clear, with conviction, things align around it. And I did the work. I found the support. I got the grades. I achieved the goal. And that was like, oh, wow, I did that. And I only did that because I decided 2 years earlier I was going to do that. And this is relevant for traders, right? Because a lot of people come to the market going, oh, I'd like to make a bit of extra money. I'd like to, get some extra income on the side, or, I kind of want to retire early. But they're all weak goals. There's no conviction. Maybe I should trade. I should learn to trade. That's a weak intention. It's not even a goal. The people that succeed have absolute, firmly held goals that are crystal clear, held with conviction, and they run after them. And when that was the first really big goal that I achieved, and when I was like, oh, it worked, right? It's like, this is kind of unexpected even. And I think that's the power of having really good goals. And most people don't have them. And I think that's a shame, because that means most people are underachieving underachieving their potential.
And I believe that when you reach that goal of yours, right, you kind of like open up a lot of opportunities to you, because you now have the mindset of, what can I achieve?
Yes!
What can stop me? And dude, you just keep, hitting all the different goals that you've set for yourself, since you've achieved it before.
Yeah.
What's next? Yeah.
Exactly right.
So yeah, that's really powerful.
That having that optimism about life is, if I want something, I can go do it. As opposed to, I've never really achieved anything.
And you've proven to yourself that you can do it based on your so-called back test.
Back test. That's right. Absolutely right. So I think that was really important to me. Not so much achieving the thing, like that was great, right? Good in the moment, but the lesson from that was what was powerful.
And before we sum up, is there anything that you'd like to add that you didn't have a chance to talk about earlier?
Yeah, we haven't talked about the typical trader's journey. Most people come to the markets and they go, oh yeah, I'll learn about stocks, and they read some books and they do some stuff and they trade a little bit, they take some tips, they do some things. And typically it takes 3 to 5 years for someone to figure it out, if they're lucky. And most people never figure it out and they give up, but some people do, but it takes long. That learning journey is really costly, because that's 3 to 5 years of lost compounding. And in 10 years' time, in 20 years' time, that's worth a fortune. If you could just have those 3 to 5 years back because you learned quickly and you got to mastery by following someone who knew how to do it, then that's worth, millions. I worked out how much my 3-year learning journey cost me, and it was millions. Yeah. If I'd have just, learned quicker and then started the compounding at the beginning, I would be so much better off now. I mean, I'm all right. I'm doing okay, but, so much better. And so I really want to encourage people to throw themselves into it, to find someone who can teach you, to shorten the learning curve, and go for it. Like, actually put in the work. Don't tinker, because that that's a decision that will change your life.
All right. And where can the audience find and connect with you?
Anyone who wants to talk to me, I mean, I think the best thing to do, we talked about that system today, go to enlightenedstocktrading.com/free, put in your details there, you'll get an email from me, and then we can start up a conversation. You'll also get all of the details for that system and a bunch of other goodies, which is kind of cool. So enlightenedstocktrading.com is my website. I've got a lot of trading articles, videos, and everything on there. Facebook, Enlightened Stock Trading, YouTube and Twitter, same thing. So basically, I'm everywhere. If you Google Adrian Reid, Enlightened Stock Trading, you'll definitely find me. So I'm very happy to receive emails with questions, comments, challenges, all of those things. So would love to hear from the audience.
Awesome. And I'll put your social media profile and website in the description somewhere below the video, right, in case the audience want to find the real Adrian Reid. Nowadays, so many scammers and imports.
Yeah, I have someone whose job every month is to look for the scammers and report them and have them removed. Like literally, this is a standing recurring task for someone in my team. So be careful out there. We'll have the real links. I'll give them to you so you can put the real links underneath. There's not many scammers because we're pretty good at taking them down, but every now and then one creeps through. So yeah, be safe.
Okay. Thank you so much for your time, Adrian. I appreciate you. Happy to have you on the show. It was a pleasure, right, speaking with you.
Absolute pleasure. Thanks so much for having me.